Hi everyone, welcome. I'm Pete Pakes, one of the co-founders and chief investment officer for Luxelocker. I want to thank you for attending this workshop today. This is basically Asset 101 about Luxelocker. It's a short workshop on what Luxelocker is building and why this asset behaves completely differently than most people think of as storage. So quick framing before we start. Today is educational. This is not an offer to sell securities. The goal is simple with everyone. Help you understand the asset class and decide whether it belongs in your portfolio or not. So let's start off with the big truth. Most investors think that storage is just storage. But the truth is, who you build for determines how the asset performs. Excuse me. If you've ever used self-storage, you already understand the baseline need. And what most people haven't seen is what happens when storage is designed for high-valued assets and high-value lifestyles. So in many cases, the structure itself is worth less than what's stored inside of it. And that single fact changes the customer and the risk profile and the outcome of the storage facility. So the core takeaways is this. Premium storage serves a different customer. It behaves differently, and it produces different outcomes than traditional self-storage does. So what's the cost of getting this wrong? It's really boils down to this. If you treat all storage as the same, you can easily end up with the wrong exposure. For example, you invest in a saturated commodity storage market. You confuse general storage demand with premium necessity-driven demand. Or you miss early exposure to an emerging sub-asset class. This workshop is meant to prevent that. What we're trying to do is we're going to keep it practical and what drives demand, what drives durability, and how the model is engineered. So the next section here is what you guys or investors actually want. We've asked nearly 200 investors in our ecosystem, what do you actually want from your investments with Luxelocker? And the answer, they're remarkably consistent. Protect my capital, predictable returns, timely execution, and that's the lens today. Not hype, no headlines. Does this behave like a durable, low beta real estate investment that protects capital and executes predictably? So what's the risks if you don't understand the asset? Well, storage can be overbuilt. Location mistakes quietly destroy returns. And most developers chase cheap land prices instead of real demand. So that's how investors end up with slow absorption, pricing pressure, kind of a race to the bottom, and it extends timelines, and especially frustrating because storage looks stable on the surface. So let's talk about the opportunity when the model is right. And that's what we've spent the last 10 years doing, is getting the model right. So when the model's right, the opportunity is different. The demand far exceeds the supply in specific zip codes. High income HOA density creates repeatable, visible needs. And larger units often mean fewer tenants, lower friction, and simpler operations. So instead of underwriting storage in general, you underwrite premium demand drivers. So you're underwriting where people live, their income profile, the assets they own, which is extremely important, and whether the product matches the lifestyle. So common investor mistakes, there's 3 mistakes we see time and time again. The first one, assuming all storage behaves the same. The second one is chasing yield without understanding demand drivers. And the third and final one is waiting until institutions validate an asset class. That is something that we have spent 10 years doing, is making sure that this becomes an institutional grade asset class. If you get these wrong, the next slide is what tends to cost. What the cost is over 10 years? Over a decade, the cost isn't just returns, it's lower compounding, more volatility than you've ever expected, and fewer true set it and forget it assets. So now the key question is what's the roadmap? How is this asset actually engineered to do what investors want it to do? So here's a little bit about the Luxelocker operating model. And this part is, most people never get to see this behind the curtain look. So how the asset is actually engineered. I'll break it down into three parts for you. One, we build for the right user, okay? And two, we design for premium demand. And three, choose land where demand exceeds supply. That's extremely important. So let's start with the user, okay? We build for two core customer profiles. First, the owner-occupant that's gonna store their own stuff, okay? People storing lifestyle, tied assets, RVs, boats, classic cars, exotic cars, business equipment, business inventory, and household goods. Second, the long-term renter. Not someone renting a unit for a few months because they're between moves. Long-term renters I defined as they have the assets, they have the lifestyle, and they need a reliable home base for it with good protective security and location that's close to their home. They rent it because it's convenient, because it's close, because it fits their routine, not because they're temporary. So the distinction matters because it changes retention, and retention changes everything in our model. And we think about storage as an extension of the home. That's why it's on all of our brochures and our collateral, not a temporary holding unit. So two operating rules guide this, all right? First rule is proximity to residence matters more than destination. People don't want their RVs somewhere in the region. They want it close enough that using it is easy, okay? The second rule is income density matters more than population size. Big population doesn't automatically mean premium demand, okay? The second part is designing for this premium demand that we're talking about. Premium storage is not nicer self-storage. It's designed around a larger flexible unit. Multiple use cases per unit and typically lower management intensity. That is traditional self-storage. There's two rules here, okay? Commodity storage is not premium storage, and saturation destroys pricing power. So we're not trying to win the race to the bottom. We're underwriting differentiation and visible demand, okay? We choose land where demand far exceeds the supply. That's where real estate outcomes are won or lost. So we score markets from macro to micro, but decisions are made at the zip code level for us. We focus on owner-occupied housing, HOA controlled communities, income, and asset density, okay? So cheap land is expensive later. I think everybody has experienced that. And data beats intuition. We are no longer the Field of Dreams company. We make decisions solely based on data. Because cheap land can cost you timelines, absorption, and pricing, which are exactly what investors care about. So, if you remember one line from this roadmap, make sure that it's this one. Buying the right dirt is what protects capital, drives returns, and shortens timelines. Okay, so next I want to make this concrete. Let's look at a few examples. No numbers, just mechanics at this point. So 3 examples we're going to talk about today. No numbers today. Just the logic of what works and what doesn't. Example 1 is it's a simple scenario. Premium storage near high-income HOA communities. Demand is visible before construction because the customer profile is obvious and concentrated in that area. When the product matches that need, absorption tends to be way more predictable. Example 2 is scaling the model. Once the criteria for that location is clear, the model becomes repeatable. It becomes a repeatable design. Multiple markets using the same criteria and refinement through execution, not theory. Example 3 is a common mistake and a correction. The early assumption is building it and they will come. Talked about the field of dreams mentality. The correction is simple. Build near where people live, not where they vacation. That's been a big hit for us, and we have the data to support that. That single shift in our business often improves demand visibility and timeline reliability. What we've learned the hard way over the last 10 years is this is why we teach the model before we talk about participation. Because this asset class only works when design and location match the user. And demand is structurally visible. So when you get that right, you get something investors value most, a durable, understandable asset with predictable execution. That question becomes this: does this belong in my portfolio or yours? So today is not about selling you an investment. It's about showing everyone how this asset class actually works. The next step isn't deciding to invest, it's deciding whether this belongs in your portfolio at all. That's what the alignment webinar is for, okay? In this alignment webinar, that's where we talk about how investors participate, the structure, the timelines, and how to evaluate the fit, whether you're a good fit or not. There's no pressure, it's clarity only. And if you want that deeper walkthrough, okay, join our Luxelocker alignment webinar using the link. It's one action, one next step, okay? Final reminder, this workshop is strictly for educational purposes only. And it's not an offer to sell securities. I want to thank everybody for your time. And I'll see you on the Luxelocker alignment webinar that you signed up for. Now, I realize some of you may have questions related to what we discussed today, and I just wanted to let you know that we have a lot to cover in a short, or we did cover a lot in a short amount of time, and we won't have time for live Q&A, but I do have a team member monitoring, and please be sure to put your questions in an email or in a form, and we won't hesitate to get those questions answered to you from one of our teammates. I appreciate your time today, and we'll see you on the Luxelocker alignment webinar.